topic for today, that is accounting standard 11. Okay. All right, people. Again, we'll cover this standard also with the help of our chart book itself. Accounting standard 11, which talks about effects of changes in foreign exchange rate. Again, a lot of the concepts that you're going to learn here in AS 11 will be carried over to your CA final also. Same topic you'll be learning as sell down. Same topic you'll be learning as Ind AS 21 with a few extra components. All right. The scope of this standard is very, very simple. Name itself is saying effects of changes in foreign exchange rate. If you have done any foreign currency transactions, our currency is what Indian currency is, Gandhi note, rupees. If you have done any transaction in a currency other than Indian rupees, meaning if you have done any transaction in a foreign currency, be it US dollars, GBP, Japanese yen, whatever, then this particular standard gives us the guidance as to what we should do. Because the problem with foreign currency transaction is foreign currencies are stable or goes on fluctuating. Like shares, even foreign currency, you can also trade in foreign currencies. And unfortunately or fortunately, share market have a particular window, like 9:15 to 3:30, it closes off. But forex market is 24/7. Okay. So foreign currencies also go on fluctuating. That means every minute, every second, it goes on changing. That means what we should do in these sort of transaction is what accounting standard 11 gives us the guidance on. That's the scope of this particular standard. Easy. All right. Okay. So basically AS 11 covers only what transactions are? Foreign currency transaction. That is a scope. Okay. Then we will dive into the other things. There will be certain definitions that will come through. I'll just quickly run through them and then we will take up few questions relating to few definitions. Okay. The first one is, the definition part is monetary item. I think we discussed this, right? It came in one of the previous standards. Monetary item means what item, sir? We discussed this. Monetary item in layman terms means the value is fixed. So actually monetary item means those components which are expressible in fixed denominations of currency. They are expressible in fixed denomination of currency. For our class purpose, we will say value is simply value is fixed. Any component whose value is fixed, we call such a component as a monetary item. I think we studied this in accounting standard 10, where there was an exchange between monetary item and non-monetary item. Yes or no? All right. So can you give me some of the examples of monetary items, sir, which we have already discussed? Whose value is fixed? Cash, or maybe I'll only tell one is a cash in hand as well as cash at bank. If you have 10,000 rupees deposit at bank, all right, that means bank is obligated to give you 10,000 back. I'm not talking about interest. I'm talking about the balance sheet component. Yes, that value is fixed. So basically cash in hand, cash at bank is an example of monetary item. Debtor is an example of monetary item. If you have to collect 1 lakh rupees from debtors, the debtor will pay you 1 lakh itself. So debtor is an example of monetary item. Creditor is an example of monetary item because the value that you're paying to creditor is also fixed. Bank loan taken. If you have taken a loan of 10 lakh rupees, how much principal are you going to repay? I'm not talking about interest. I'm talking about principal. Okay. Interest you will show it in P&L, right? Loan, where will you show? Balance sheet, right? So if you have taken 10 lakh principal from bank, how much principal you will repay? 10 lakh itself. That means that principal portion is fluctuating or same? Same, meaning its value is fixed. So loan taken, loan given, all these are again an example of what item? Monetary items. Easy, people? Pretty straightforward? Okay. Sir, something which is not a monetary item automatically becomes what? Non-monetary item. In fact, non-monetary item, there is no definition. They have defined what is monetary item. Something which is not a monetary item becomes automatically non-monetary item. So if monetary item ka value is fixed means non-monetary item ka value fixed or value fluctuates? Value fluctuates, meaning value changes. So can you tell me some of the examples of non-monetary item which we have already gone through? One is your inventory. If you have inventory worth 10 lakh rupees in your books now, tomorrow also its value is 10 lakh only, or it may change. It may change, right? If you find a bakra, you will sell it at a higher price. Otherwise, you yourself may become a bakra and sell it at a lower price. Possible, meaning the value fluctuates. So inventory is an example of non-monetary item. If you have any property, plant and equipment worth 5 lakh in your books, its value will be constantly 5 lakh, or again it goes up and down. It may increase also, but generally its value decreases. That means here when we say value fluctuates, the fluctuation could be on the increase side or it could go on the decrease side. So is value same of PP or changing? Changing. So property, plant and equipment also is an example of non-monetary item. If you have any intangible assets like patent, copyrights, etc., etc., even they are an example of non-monetary item because even their value also fluctuates. Any problem with this? Okay. The next thing, first we will blindly learn them, then I'll tell you the importance, why did we learn all this, okay? Okay, next is, don't worry about financial asset, okay? We don't know what is financial asset. Financial asset is not within your CA inter syllabus, it is in the CA finance syllabus. Yes, financial asset also, financial asset depends. Not all financial assets are monetary, you could have both there. So you don't know the full component. There are 6 features of financial assets, which will be get covered under India's 9. Some portion of that is a monetary item, some are not. So do not worry about that for the time being. Come back to the things that are there in our syllabus. Okay. Next one is foreign operations. So foreign operations simply means, name itself is saying foreign operations. It's possible that like here do we have only one unit, or we have couple of locations? We have one center in Bengaluru, another one in Chennai currently. Yes or no? Like that, we can have one unit in India, another unit in outside India, maybe in a foreign country. Yes or no? That foreign branch or that foreign subsidiary, that foreign joint venture or foreign associate is what we refer to as what? Foreign operations. Basically, if you have any branch or if you have any subsidiary company, sir, when do you call it as a subsidiary company? We did consolidation already. When you have a control. And when can you have a control? When you own more than 50%. One company owns more than 50% in another company, then this company, company holding, we call it as holding company. Other company, we call it as subsidiary. Is it necessary subsidiary company has to be in India, or it could be a foreign subsidiary also? Foreign subsidiary also. Or another one is a joint venture. Joint venture means, sir, with more than 50% you get control. If you own exactly 50%, joint control. That we call it as joint venture. Okay, like that is one. Okay, if you have that also. Or it could be an associate company. Associate company means if you own more than 20%. With more than 50% you get control. With more than 20% you own, with 20% will you get control? No. If you own more than 20% or more in another company, we call such a company as an associate company. 20% or more but less than 50%. Also basically investment, if I have to tell, more than 20% but less than 50%, it becomes what, sir? Associate company. At 50%, it becomes something called JV, as in joint venture. More than 50%, the other company becomes your subsidiary. Okay. If it is less than 20%, it is your normal investment. It is your normal investment. Okay. For each of them, we have a different standard, which talks about it. Okay, people? All right. So that is what is covered over here. If you have any branch, or if you have any associate, or if you have any joint venture, or if you have any subsidiary, where? Outside India. That means they are operating in India or they are operating outside India. Outside India. That outside India ka entity, we call it as what? Foreign operations. That's the definition. Is it okay, sir? So foreign operation simply means a unit which is operating in India or outside India. The main entity is operating in India. Another branch or JV or subsidiary is operating outside India. That outside Indian entity, we calling it as foreign operations. Fine, sir. Again, I will not go into why. In a bit, we will get to all this. First, we will quickly run through them. Okay, sir. Online also fine so far there. Keep an open mind for the next 15-20 minutes. I'll tell you the why. I'll collate it also. Why are we studying all this also on the... Okay. So foreign operations are of 2 types. Foreign operations are of 2 types. Integral foreign operations, non-integral foreign operations. Integral foreign operations, non-integral foreign operations. So what do we mean by, we know what is already foreign operation. Basically that operation or that entity who's conducting their operation in India or outside India? Outside India. That outside Indian entity could be an integral foreign operation or Non-integral foreign operation. Sir, how is this the integral, or when can you call it as integral foreign operation? Sir, if the Indian entity and that foreign operations, if they are closely related, if the Indian entity and foreign operations, if they are closely related with terms of operations, then that foreign operation becomes what, sir? Integral foreign operations. Meaning, if both of them are working together, it's like foreign operation is just an extension of Indian entity. If foreign operation is just an extension of Indian entity, such a foreign operation we call it as what, sir? Integral foreign operations. Like here, I'll give you a small example. Check this. Sir, let's say Infosys India. The main company is Infosys, okay? The head office is there in where, sir? Bengaluru. Yes. Now, this particular Infosys Limited, no, sir, they are working on developing a new software. Their Bengaluru division, no, works on the software. First 40% of the software is completed by Bengaluru division. Okay. After that, what is the balance, sir? Balance 60% of the software is developed by Infosys US. Infosys has a branch in US, let's assuming. They have a main office in India. They have a branch in US. They are developing a particular product. First 40% of the product is developed by the Indian entity. Balance 60% is developed by which entity? Same, Infosys ka foreign branch. Now you tell me, are Bengaluru branch, the main entity, and US branch, are they independent or integrated or interrelated with each other? They're highly dependent on each other. Yes or no? That means you tell me, this US ka entity, we call it as foreign operation. This US entity, which is foreign operation, is an integral foreign operation or a non-integral foreign operation. This US foreign operation becomes your integral foreign operation because the Indian entity and for US are closely related. Though this US operation may be situated in outside India, it's as good as what? US entity is just an extension of the Indian office. So that scenario we call it as what, sir? Integral foreign operations. Any problem? Okay. Something which is not an integral foreign operation automatically becomes non-integral foreign operations. Like, to give you an example or continuing with the same example, same company Infosys, Bengaluru division is developing software 1. Full software, one of the software is developed by Bengaluru division. Another software number 2 is developed by US. Completely different software. Bengaluru is working on one software and US division is working on another completely different software. Now you tell me, is there any connection between Bengaluru and US, or all of them are functioning independently? They're functioning independently. Now this US division only we're calling it as foreign operation. Now you tell me, this foreign operation is an integral foreign operation or non-integral foreign operation? This US becomes your non-integral foreign operations. Okay, sir. Need a minute or carry on? Carry. Okay, let's do a thing. Let's have one quick recap. What is the standard name, sir? Accounting standard 11. What is the scope of AS 11? It covers all your foreign currency transactions. Okay, that's a scope. Then we learned what is the monetary item. Monetary item means those items, both income and or asset and liability, whose value is fixed. Examples could be your cash, debtor, creditor, loan taken, loan given, bill receivable, bills payable, etc., etc. Non-monetary item means whose value fluctuates. Example could be your inventory, intangible assets, PPs, etc. Then we looked at foreign operations. Foreign operation means those operations, or it could either be a branch or subsidiary company or joint venture or associate company whose operation is done in India or outside India. Operation is done outside India. That foreign operation could be of two types: IFO as an integral foreign operation or NIFO as a non-integral foreign operation. When it is an IFO, when Indian entity and foreign operations are closely related, meaning though they are located in different countries, it's as good as the foreign operation is an extension of the Indian entity. Such a scenario we call it as integral foreign operation. Something which is not an integral foreign operation automatically becomes non-integral foreign operations. Okay. All right, people. Now coming to the most important part of the topic. I'll come to why did we discuss this also. I'll come to it in a bit. Okay. Now we'll take up the most important one. If you have done any foreign currency transaction, let's say we have sold goods to a foreign currency debtor. We have sold goods to a particular debtor. That debtor is not there in India. Let's say he is there in Japan. Okay. In that case, what we need to do? AS11 says initial recognition. Initial recognition means today you have sold the goods to somebody. That means today you need to pass the journal entry. What is the journal entry for credit sales, sir? Debtors to sales. Let's say I've sold the goods for $1 lakh. I'm an Indian entity, but I've sold goods to a US debtor and my billing is in Indian rupees or it is in dollars? Dollars. And how much lakh dollars? $1 lakh. Can we pass the journal entry in dollars like debtors account debit to sales 1 lakh, 1 lakh? In current scenario is $1 is equal to 1 rupee. We wish that happens soon, but currently it is not so. A dollar is a much stronger currency, whether we want it or not. That's the fact. Yes. So dollar is a much stronger currency. Currently, what $1 is probably 80 or 85 rupees, roughly around that range now. Yes, 80 to somebody saying, yeah, could be. All right. We have billed it in dollars, but can we account it in dollars or we have to account it in rupees? We have to account it in rupees. That means rupee value you have to, or dollar value you have to convert it into rupees. Correct? That we are calling it as initial recognition. So all foreign currency transaction, doesn't matter whether it is a monetary item or a non-monetary item. Initially, all foreign currency transactions are recorded at transaction date ka spot rate. Meaning, let's say I sold goods to a foreign debtor on 1st April 2024. Okay. On that particular date, the dollar value was $1 is equal to 80 rupees. And I made a sale of $1 lakh. So what will I do? This $1 is equal to 80 rupees. What is the transaction date, sir? 1st April 2024. What is the exchange rate on this date? $1 is equal to 80 rupees. That we are calling it as transaction date ka spot rate. This on the date of transaction, whatever exchange rate was there, we call it as TDSR. TDSR as in transaction date spot rate. Are we good? So all transaction or all foreign currency transactions are initially recorded using transaction date ka spot rate. What's the journal entry for credit sales, sir? Debtors account debit to sales. Easy. But this debtor ka value is in rupees or it's in dollars? Dollars. So it's there as $1 lakh. Sir, $1 is equal to 80 rupees. $1 lakh will be how much, sir? $1 lakh will be X. You have to cross multiply simply. If $1 is equal to 80 rupees, then $1 lakh will be 1 lakh 80, which will be 80 lakh. This 80 lakh rupees is in dollars or it's in INR. So convert the dollar value into Indian rupees using transaction date ka spot rate, which will be given to you in the question. That is your initial recognition, both for monetary items and non-monetary items. This is the first thing you need to remember. It will come. All this, you can write it in words and explain, or you can call it out in journal entry and explain. These sort of problems are popular in examination. We're going to solve a few of them also here in class. Yes, people. Once again, what is that? Initially, all transaction or for all foreign currency transaction are recorded using TDSR. TDSR means transaction date ka spot rate. Meaning on the date of transaction, whatever exchange rate was there, use that and convert foreign currency transaction into Indian rupees. So in my example, $1 was equal to 80 rupees. So I use that and we converted, and the converted value has come to 80 lakh rupees. That is the first provision. Easy. Huh? What basis? Basis is like in a difficult to tell because a lot of foreign currency transaction happens now. Because see, now earlier, no, like it's like though we say each is a separate country. Country is not just dependent on its citizens, they are also dependent on other countries. Lot of trading happens, import, exports. That means you'll have to settle. When you have to settle, obviously the value goes on fluctuating. Okay, so that means factors could be anything. Again, it's like a share price. Theoretically, you could say its value, foreign currency fluctuates because of its country ka GDP, its population, its earning capacity, etc., etc. But it's, if you think about it, theoretically it is so. Practically, it is more to do with demand and supply. Like share price. Share price, you could say that normally if company is doing good, share price we expect to increase theoretically. Okay, but if any big player dumps lot of shares, that means share value will reduce. Doesn't matter how good a company it is, still it will fall because supply is more than the demand. So it works basically on your supply demand concept basically. Okay, the tracking wise. Okay, can I come back to this one now? Okay, what was I saying? This is your initial recognition. 1 minute, people. I just modify this date for the sake of example. I'll take this as, let's say, 1st March 2024. Transaction happened on 1st March 2024. Sir, if you have on 1st March 2024, what have I done? Have I purchased the goods or sold the goods? Sold the goods. That means it's a credit sale. I will receive the money. Let's say I received the money on, I'll leave some space. I received the money on 1st May 2024. I gave a 2 or 3 months credit to my foreign currency data. So I received the money on which date? 1st May 2024. So what's the journal entry for money received from debtors? Bank account debit to debtors. Okay. Sir, if my billing is in dollars, the debtor will pay me in Indian rupees or he will settle in dollar only? Since I billed $1 lakh, that debtor will give me how much? $1 lakh. That means what I have received is not rupees, I have received it in dollars. Okay. Can I account it in dollars or again convert? Again convert. This is what? It is transaction date or settlement. What sort of? Is this a transaction, initial transaction, or is it a settlement transaction? So what AS 11 says is all settlements. Settlements here includes both receipt as well as payment. All settlements are recorded using settlement date ka spot rate. Or settlements are recorded at settlement date ka spot rate. In this case, when are you receiving money, sir? 1st May 2024. Let's say on 1st May 2024, $1 was equal to 82 rupees. $1 has become 82 rupees. Any problem, people? No. That means how much money will come into your bank account? 1 lakh into 82 rupees, which is 82 lakhs. Any problems, sir? Any problems, sir? No, sir. That means you'll write here bank account debit to what account? To debtors account 82 lakhs. Any problem? I'll not complete this value. Hang on. But so far, did we understand the concept? Initially, all transactions are recorded at transaction date ka spot rate. All settlements are also recorded at settlement date ka spot rate. Easy? It could pay, it could increase, it could decrease. Don't worry about increase, decrease. All such problems will arise. Okay. In my problem, I've assumed it as increase. It could also reduce. Doesn't matter. Listen to this very carefully. Most company dealing with foreign currency have a net worth of 250 crores. No, not necessary. You could have anything. That is irrelevant.
If a person has a
And since, sorry, I didn't get that. Property exchange. Again, rephrase your example.
one person has property, means seller has a property in foreign. The buyer won't give foreign currency. He will settle this property.
Give me the data. I'll write it down. Maybe X limited, Y limited. Tell this one.
X limited is a foreign.
He's a buyer, seller. What? He's a buyer. Okay.
Y limited is a seller.
Okay. Seller.
X limited, what? The buyer will settle the property with Indian.
Both have one property in India.
You're doing a property exchange. Property exchange means this will not come in. You're not paying cash here. No, you're settling in property means you have to apply exchange provision of AS10. What does exchange provision of AS10 say? If the transaction has commercial substance, you have to use the fair value and record it. Okay, but fair value determination, you need to convert it. The day you are selling that property, checks the exchange rate, and using that you find out fair value. Fair value has to be determined in Indian rupees. So use that. So AS11 you don't need it there. Okay, just for the exchange rate you can use that there. Okay, come back to this one, people. All right, check this example. Sir, when did we sell the goods? 1st March 2024. Okay. All right, but when are we settling these goods or when are we receiving the money? 1st May 2024. So this is your transaction date or this is your settlement date. Now we know that transaction has to be recorded using transaction date ka spot rate. Settlement has to be recorded at settlement date ka spot rate. That is not the problem. But between this transaction and settlement, one important date is arising. Can someone point out this? Between your transaction and between your settlement, one important date is arising, which is your 1st March to 1st May. There is one important date arising, which is 31st March 2020. 31st March 2024 is the date on which you close your books, meaning you prepare your balance sheet or you prepare your financial statements. Can I call it? Okay, people. All right. So listen to this. This is important. Between transaction and settlement, okay, between transaction and settlement, if you're closing the books, That means you tell me, have you received money from this debtors on the balance sheet date or yet to receive? Yet to receive, because you will receive the money on 31st March or on 1st May. 1st May. That means foreign currency, this particular debtor has a balance, correct? So what the standard says is, between this transaction date and settlement date, if your foreign currency item has the balance, if any foreign currency component has the balance, first check whether that component is a monetary item or a non-monetary item. That is why we studied first monetary and non-monetary. Be able to understand between settlement date, again between settlement date and or between transaction date and settlement date, check if you are preparing. One important date is arising. What is that important date? You are closing your books. Okay, that is 31st March. Generally, you close the books on 31st March. Sometimes you can also close it on 31st December. So date is irrelevant. Check if the closure date is coming in. Check on the closure date if any foreign currency component still has any balance. Here, do we have still money to be received from debtors? Yes, that means that foreign currency still has a balance. Check whether that debtor, which here has a balance, is a monetary item or a non-monetary item. Tell me, sir. Now, debtor has a balance. This debtor is an example of monetary item or non-monetary? Monetary item. Sir, standard says all monetary item has to be shown in the balance sheet using closing rate. All monetary items should be reflected in the balance sheet using closing rate. Now, what is this now? We got to know two rates. TDSR, which is transaction date ka spot rate. SDSR, which is settlement date ka spot rate. Now, we got one more, which is what, sir? Closing rate. Sir, it's common sense. When are you closing your books? 31st March. The exchange rate on 31st March 2024, we call it as CR. CR as in closing rate. Okay. Let us say $1 on 31st March has become 81 rupees. $1 is equal to 81 rupees. Any problem, people? Everybody okay? Now, as on 31st March, carefully pay attention to this. This is only a problem. If you understand this, you don't need me for the next one or two problems. Ditto, same thing. I'm trying to explain this with the help of one small scenario itself. Check. On 31st March 2021, what is the closing rate again? $1 is equal to 81. So which component has a balance here? Debtor. And debtor is a monetary item or a non-monetary item? It's a monetary item. And what does AS 11 say? All monetary items should be shown in your balance sheet using what? Closing rate. Meaning debtor should be converted and shown in your balance sheet using closing rate. And what is the closing rate, sir? 81. Hang on. Did you convert the debtor at 81 or 80? 80. Because why 80? Because transaction date ka spot rate was 80. So you converted at 80. But can you show this debtor at 80 value in balance sheet or 81? 81. Okay, sir. You have to show it at 81. So that means 1 lakh into 81 is how much? 1 lakh into 81 is how much? 81 lakh. That means debtor has to be shown not at 80 lakh. It has to be shown at 1 lakh multiplied by 81, which is 81 lakh Indian rupees. Correct? Debtor has to get reflected in your balance sheet at 81 lakh rupees. But currently debtor is shown in your books at what value? 80 lakhs. Currently it is shown at 80 lakhs. But you have to show in your balance sheet at 81 lakh. So debtor ka balance you need to reduce or increase? Increase. So debtor as an asset, assets have debit balance. How do you increase something which has debit balance? Debit. That means on 31st March 2024, you need to pass one more entry, which is going down. On 31st March, you need to pass one more entry, which is what, sir? Debtor balance reduce or increase? So you'll write here debtor's account debit. How much? 1 lakh. Can I write like this? $1 lakh you have to convert at 81, but you have converted at 80. That means how much you need to increase it by? $1 you need to increase it by 1 rupees. $1 lakh, how much you will increase it by? 1 lakh into 1, which will be how much? 1 lakh rupees. Correct, no? Any problem? So debtor's account you will debit by 1 lakh. Now you think you have a sad face or happy face? Sad face or happy face? Sir, when you have sold the goods, that means you have to pay the debtor or receive money from debtor? Receive money. On the transaction date, you thought you will receive 80 lakh rupees from the debtor. But on 31st March, it looks like how much money you will collect from debtors? 81 lakh rupees. Okay, that means he's going to pay you 1 lakh rupees extra. Looks like that. Yes or no? Has he already paid? Can I credit bank or anything over here? Has he already paid, or this is a, what is this? This is a gain that is arising due to your forex fluctuations. Because in the transaction date, the dollar rate was $1 is equal to 80. But on 31st March, it has become $1 is equal to 81. I mean, because of dollar fluctuation, you are getting this 1 lakh rupees extra gain. Yes or no? That forex gain, no, will be transferred out directly to P&L account. Could be a case of forex gain or could be a case of forex loss. Doesn't matter, that forex gain or loss will be transferred off to P&L. This is the journal entry you need to pass on 31st March. Any doubt, people? Once more, people, got it, people? Online also confirms. No need to copy any of the example. We have 1 or 2 extra problems like this only, which we will do with journal entry. Just to illustrate this, I'm just taking a random example there. That's all. Okay. Okay, great. Now look at this. Let's take it further. Is the drama over? No. 31st March drama is over. But when is actual settlement happening? 1st May 2024. And what does AS 11 say? All settlements should be recorded at settlement date ka spot rate. On settlement, $1 is equal to how much, sir? 82 rupees. Further sadness or further happiness? Sir, initially when you did the transaction, $1 is equal to 80 rupees. You thought on $1 we will receive 80 rupees. On 31st March, $1 is equal to 81 rupees. That means we will receive 1 rupees extra. Hence, we booked the gain of 1 rupee over here. Yes. Now, on 1st May 2024, how much money eventually came into your bank account? $1 is equal to 82 rupees. How many lakh dollars? $1 lakh. That means bank account debit how much? 82 lakh rupees. Correct, people? Have you already received total money from your debtors? Yes. That means debtor account should still have a balance or close it. Close. Check how much is the debtor balance, sir. Initially, you debited debtors by 80. Then again on 31st March, you debited debtors by 1 lakh. That means debtor ka balance is how much? 81 lakh. So debtor has a debit balance of 81 lakh. How do you close it? Close by crediting debtors to the extent of 81 lakh. Is the journal entry matching? No. You thought on 31st March you will receive 81, but eventually you receive 82 lakh. That means you receive 1 lakh rupees more here. Why? Again, due to your forex fluctuation. That forex gain or loss again will go where? Transferred off to P&L account. Either you can calculate or get it as a balancing. This is all this whole funda. This 3 chart is talking about that. I thought just by explaining it will not make sense. So I took a small example to illustrate this. Yes, people? You want one more example like this? Yes? Okay. So let's maybe take one more example and then we'll see. 15th March 2024. Oh, previous example was towards sales. Now we'll take one towards purchase. Opposite one. 15th March 2024. No, sir. You purchased. This time around, you purchased it from US creditor. You imported the goods. Okay. So from a US vendor. So let's say you purchased $1 lakh worth of goods. You purchased goods worth $1 lakh. Okay. I'll give you some components. Okay, on 15th March 2024, no sir, $1 was equal to, let's say, 80 rupees. On 31st March 2024, $1 is equal to, let's say, 80. No, we'll take the other ones. 77, we'll take it. On settlement date, this is your settlement date. 1st May is your settlement. On 1st May 2024, let's say $1 has become 83 rupees. Okay. It could fluctuate and become anything. No, I've assumed some random rates. Okay. Now you will have to tell me the accounting treatment for all this. Solution. Okay. So first tell me the provision. What does AS 11 say? All transaction, doesn't matter whether it is monetary or non-monetary, all foreign currency transactions are initially recorded using TDSR. TDSR as in transaction date ka spot rate. You can also call it as transaction date ka exchange rate. That is also fine. Or you can call it as transaction date ka spot rate. That is one. And then settlements are recorded at settlement date ka spot rate. That is one. And the third one, between this transaction and settlement, if you're closing your books and that foreign currency component has any balance, check what sort of a component is that foreign currency item. It could be a monetary or a non-monetary. If it is monetary item, all such components should be reflected at closing rate. Easy. That is a provision. Can we solve this scenario using that particular provision? Okay. Sir, when did you purchase the goods? 15th March. So on 15th March 2024, what is the journal entry for credit purchase, sir? Purchases account debit to creditors. Sir, can I record it at $1 lakh or I have to convert? Convert. Okay. This is what? What do we call this as? This is your initial recognition, IR. Initially, all transactions are recorded at transaction date ka spot rate. Transaction happened on 15th March. On 15th March, $1 was equal to 80 rupees. That means $1 lakh will be, can I directly multiply? 1 lakh into 80, which will be 80 lakh rupees. This is your first. Done, sir? Okay. Sir, settlement is happening on 1st May. But before settlement, are you closing your books? Yes. You're closing your books on which date? 31st March 2024. So 31st March, you're closing your books. Okay. This particular component, creditor, it is a monetary item or a non-monetary item? Monetary or a non-monetary? So creditor is non-monetary item, sir. Because no, due to forex fluctuation, we may pay more or we may pay less. Sir, monetary item means value is fixed. And value could be fixed in any currency. It's not necessary that value has to be fixed in INR. It could be fixed in any currency. Here, how much have I purchased the goods from creditor? $1 lakh. That means how much dollars I'm going to give it to him? $1 lakh. That means dollar in $1 lakh, that value is freezed. INR value may fluctuate, but dollar value is fixed. So creditor is an example again of what? A monetary item only. Is it okay, sir? All. And what does the standard say? All monetary item at balance sheet should be reflected at closing rate. Closing rate means the exchange rate existing on the day you close the books. You're closing the books on 31st March, and at the time of closure, $1 is equal to how much, sir? 77. That means you should have converted and shown the creditor at $1 is equal to 77 rate. But I have converted at $1 as 80. That means what should be the creditor's balance, sir? Creditor's balance should be $1 is, in fact, 1 lakh into, it should be converted at 1 lakh into 77 because 77 is the closing rate. So creditor should be shown at 77. But currently my creditor is shown at what value? 80 lakhs. Currently shown at 80, but I have to bring it down to 77. Sad or happy? Happy, sad. What is happy? Sir, initially when I did the transaction, to pay $1, I have to pay here. No, I'm not receiving here. Here I'm paying. To pay $1, how many rupees I have to give away? To pay $1, I have to give away 80 rupees. But on 31st March, I can purchase $1 by just paying 77. I can just give 77 rupees and get $1. That means I'm paying more rupees or less rupees. Obviously, so it's a case of a sad or happy scenario. Happy scenario. Or if you don't want that, just check this. Creditor is currently shown at 80. It is to be shown in balance sheet at 77. So creditor value you need to reduce or increase. You need to reduce. Creditor has what balance? Creditor is a liability. It has credit balance. How do you reduce it? Debit. So what's the journal entry you will pass on 31st March? Creditor's account debit. Okay. I've converted this $1 lakh at 80 rupees, but it should be converted at 877. So how much more have I converted at? 3 rupees. That which I don't know. Yes, people. So how much is this? 3 lakh. Okay. So this is nothing but 80 lakh minus 77 lakh, which is 3 lakh. Comfortable? Okay. Am I paying this 3 lakh right now, or this is a forex fluctuation? This 3 lakh rupees gain has arisen only due to forex fluctuation. Where will it go? Doesn't matter whether it is a forex gain or a forex loss. It will be transferred of where? To P&L account. Easy, sir. This is the entry we'll pass on which date? 31st March. That is your closing. So when you pass this entry, initially you credited creditors by 80 lakh. Now you debited by 3 lakh. So creditors ka balance will become 77 lakh. And in the balance sheet, creditors will be shown as current liability at to the extent of 77 lakh Indian rupees. Can I go for the last one? Okay. When is the settlement happening, sir? Online also okay till here, no? No need to copy this. We have 2 more questions like this only. Just to explain the concept, taken some random example. That's all. Okay. Settlement is happening on which dates? 1st May 2024. 4. Sir, what is the journal entry for amount paid to creditors? The journal entry is creditors account, debit to bank account. Okay, 1 second, we'll see. Sir, currently check what is creditors. Now we have already paid the creditors. That means creditor account should have a balance or you should close it. Close. Initially you credited creditors by 80 lakh, then you debited by 3 lakh. That means creditors ka balance is how much? 77. So creditor has a credit balance of 77 lakh. You will nullify by what? By debiting to the extent of 77. Any problem? No. But are you paying 77 lakh? No. On the settlement date, what is the exchange rate, sir? $1 is equal to 83. Okay. On $1 you have to pay 83 rupees. $1 83 rupees means $1 lakh how much, sir? 83 lakh rupees. Yes, no? That means how much money will eventually go from your bank account? 83 lakh Indian rupees will go away. You thought you will pay 77 till 31st March, but eventually that payment came out to be 83 lakh. Matching or difference? How much difference? 6 lakh rupees. Now this 6 lakh rupees is what? Forex gain or loss? Loss. Gain means you will credit it. Yes, no, because incomes and gains will have a credit balance. Expense and loss will have a debit balance. You're getting a balancing figure on the debit side means obviously it's a case of a loss. That way also if you want you can understand. So where will this go? P&L account. Okay, you can calculate or arrive it as a balancing figure. It's all right. This is the fund. Not sorted. Okay, G. Can I come back to the chart, G? All right. Sir, all this, if you observe, we revolved around monetary item. If you just check all this treatment, we have done it for monetary item. Sir, what if it's a non-monetary item? Non-monetary item are not tested in your examination. Okay, in fact, I have not seen any question also, but nonetheless, I brought it in. Just let's quickly run them over. Okay. All right. So, same, sir. Its funda is the same. Initial recognition for non-monetary item also at transaction date ka spot rate. Settlement also at settlement date ka spot rate. That concept is same. But between this transaction date and settlement date, if you have any balance, meaning you're preparing any balance sheet, check whether that foreign currency component is a monetary or a non-monetary. If it is a monetary item, you'll convert using what rate? Closing rate. However, if it's a non-monetary item, meaning value fluctuates. Like what is an example of non-monetary item? Inventory. If you have purchased some goods. Okay, if you just check in the previous example, we passed the journal entry purchases account debit to creditor. Creditor is an example of monetary item. But purchases means if you purchase the goods and if you have not sold, you will show this as the closing stock. Stock is an example of what item? Non-monetary item. Did we do anything for that? No. Why? Because of that, we'll see in the chart there. That's the reason. Okay. So if you have any non-monetary item, first check how is that non-monetary item valued. How is that non-monetary item valued? Like inventories. Inventory is valued at cost or NRV, whichever is low. For property, plant and equipment, you can value PPEs at cost model or revaluation. Like this, you have various valuation principles around non-monetary item. First, check how are they valued. If it is valued at cost, which will be the case mostly, then you don't have to do anything. You don't have to do anything. Meaning, initially when you purchased inventory or initially when you purchased intangible asset or initially when you purchased PPE, did you record it at foreign currency or you convert it? You converted into what? You converted into Indian rupees by doing what? By using what? Transaction date ka spot. You show the PP in your balance sheet at the same rate. Initially, if you purchased a PP and converted it, let's say 80 rupees, you purchased PP for, let's say $10,000. And the date of purchase, the dollar value was, let's say $1 is equal to 80 rupees. So you will convert it, $10,000 into 80 will give you how much, sir? 8 lakh rupees. That means you would have passed the journal entry PP account debit to bank account or PP account debit to vendor account 8 lakh rupees. Yes, no? This 8 lakh is dollar value or Indian rupees? Indian rupees. Yes, no? So you already converted. In the balance sheet also, you continue to show that PP at same rate. No further drama for exchange loss or exchange gain or loss is required is what AS11 is saying. Because they have taken a view that these non-monetary items, you may not sell it in often. So that's the reason they've said you can continue with the old rate itself. You need not again go into further conversion. So if it is valued at cost, again, this section is not that important. Just know it in case they want, they can ask as an MCQ at best. Problems will definitely not come. Okay, and CA final also this is not tested. Any which way, cost. So if non-monetary item is valued at cost means, should you have to do any extra drama or same thing? Anyway, you have converted already, show the same value in your balance sheet. So what about depreciation? All that is common. Depreciation and all will arise normal. All that is common. But should you have to do any further exchange gain loss wala drama or not required? Not required. For what component? If non-monetary item is valued at cost. However, if it is valued at any other value, meaning inventory could also be valued at net realizable value, PPE could also be valued at revaluation model, like that. So if you are valuing the inventory at NRV or fair value, then sir, you will find out NRV or fair value on a particular date. You will find out NRV or fair value on particular date. Which particular date is that? You find out NRV on which dates? And the closure date. Yes. So whichever date you're finding NRV or fair value, that particular day will have an exchange rate. Use that particular exchange rate and convert it. Okay. Initially you purchase PPE at, let's say, on 10th March 2024. Okay. Suppose this PP, that means you have initially recorded this PP at what value? 8 lakh rupees. Suppose on 31st March 2024, you want to go for revaluation model. Revaluation model. That means for revaluation model means you need to show this PP at fair value. You'll find out fair value on which date? On 31st March 2024. That means on 31st March 2024, you will have an exchange rate. Let's say $1 is equal to, let's say 81 on that day. So convert your PP using not at 80 but at 81 rupees. Okay, people? That is what this particular standard is saying. Use the exchange rate on the date fair value or net realizable value is determined. So what will happen to exchange gain or loss? It is little outside your syllabus. There is a specific component that we say it should be accounted as per the respective AS. Like if you do revaluation and if you get revaluation gain, what will you do? If you do revaluation and if you get revaluation gain, where will you put that revaluation gain in P&L or revaluation surplus? Revaluation surplus. That means exchange gain loss also should go to revaluation surplus. You did a revaluation and you got revaluation loss. Then that revaluation loss, where will you transfer it to? P&L. That means this exchange gain loss also will go up to P&L, like that. That is what the standard says. So convert it at, use exchange rate on the day you found out net realizable value or fair value. And exchange gain or loss is not as per AS 11. Exchange gain loss will be as per respective accounting standard. What is the respective accounting standard for PPE, sir? Accounting standard 10. Accordingly, you need to do it statement. So this is not tested for at your level at all. For your reference, I'm saying. In fact, this is not there in your books also, if my memory serves right. But you may have that doubt, so I thought I'll bring it in. But no, wait, anyway, same concept is there in your CA final also. Same chart, same drama, etc., etc., etc. will continue. Okay, G. Once more, G. Got it, G. What, G? Interesting enough? Something new? I think this is entirely new. We have not gone through this, I believe.
Person was Subramani
Uh-huh.
and Raghavan. There are two persons. Subramani was agreed to buy Raghavan property. And when he buys the property, the dollar was 81 rupees. He paid 50% of property. And then what he would like to pay in future. Then how will we?
Initial transaction at transaction date ka spot rate. Settlement at settlement date ka spot rate. Gain or loss, two transactions. You record PP at that particular value. Use on the transaction date, whatever exchange rate was there, account fully. Okay. Balance you need to do it later. That's it. Create a vendor account. Exchange gain loss will come. Exchange gain loss is as per the respective AS. That's it. How depreciation will come? PP means depreciation will arise. No? Property, plant and equipment means will you depreciate it or ignore it? You will depreciate. That concept and all is common. That you need not bring it into AS 11 ka terminology. Okay, just 1 minute. Let's have a quick recap and then we'll apply the same thing in 2 more questions to get our understanding better. 1 minute, people. Listen. So again, we're talking only about this particular thing. Initially, all foreign currency transaction. When I say all, it includes both monetary as well as non-monetary. Initially, all foreign currency transactions are recorded at transaction date ka spot rate. All transactions, be it monetary or non-monetary. All settlement transactions will be recorded at settlement date ka spot rate. Then between this transaction and settlement, if you are closing your books, then you need to check if any foreign currency component has any balance. First, check whether that foreign currency component is a monetary item or a non-monetary item. If it is monetary item, then you'll have to show that monetary item in your balance sheet using closing rate. Closing rate means the exchange rate applicable on the day you close the books, which generally will be your 31st March. So the exchange rate on 31st March becomes your closing rate. So convert monetary item using closing rate, and any gain or loss will be transferred off to P&L. That's one. If it's, however, a non-monetary item, then you need to check how is that non-monetary item valued. It could be valued at cost, or it could be some other things. If it is valued at cost, any extra drama or nothing. Anyway, already you have converted it, show the same value in balance sheet. If there is any depreciation, amortization, etc., those principles are any which way same. However, if non-monetary item are valued at net realizable value, or for that matter at fair value, then you need to find out this fair value or NRV was determined on which particular date, which generally will be again 31st March. So on 31st March, you need to find out what is the exchange rate. And using that exchange rate, this non-monetary item again has to be reconverted. When you reconvert, obviously you will get some further forex gain, or for that matter further forex loss. That forex gain or loss will straight away go to P&L or as per respective A's. As per the respective A's. You'll have to check what does the respective A's gives the treatment. Accordingly, this gain or loss will be transferred. Okay, that is all is the funda we have discussed. Can we go for a couple of questions, people? 1 minute, let me pick out that. Okay, I think we'll go for question number 1. There are other parts of the chart also. Hang on to that. Okay. Don't look at the solutions. I'll tell you inventory. Sir, first question is, don't look at the question. Just look at the screen. Tell me, sir. You need to classify a component as monetary or non-monetary. Inventory. Non-monetary asset. Trade receivables. Monetary asset. Investment in equity shares. Investment in equity shares. Sir, if you purchase investment in equity shares, value will be same or fluctuates? Fluctuate. So what sort of an item? Non-monetary item. Property, plant and equipment. Property, plant and equipment is also NMI, as in non-monetary item. Answer is given here. Okay. These sort of questions also have come in the past. They may ask this for 2 marks, 3 marks, etc. 5-6 components they will give and ask you to classify it as whether monetary or non-monetary. That questions also have come. Can I move on to the next one? Not necessary. If it comes for only, like let's say this comes for 2 marks, that means each answer carries half a mark. So don't have to waste time in explanation. Just write the answer. It's good. Monetary value is fixed. Bond is also, yes, you can treat them as monetary item. No, the traded ka value, the bond ka value doesn't change too much. It's a subjective call, okay, you can say, but generally its value doesn't fluctuate too much also as compared to equity shares. So in my opinion, you can treat that as a monetary item. It again depends on what kind of a bond also. Because some bonds are like government bonds, RBI bonds, they don't fluctuate in value. Like most of the AAA bonds, as we say, they don't fluctuate too much. But if it's unsecured bonds, AA bonds or A negative bonds like this, you will see based on your credit rating agencies' ratings, that could fluctuate. So then if you want, you can also treat it as a non-monetary. You'll have to assess it on a case by case there. LIBOR is a benchmark rate. LIBOR is not used for your normal transaction. LIBOR is used for your fixing your rate. Like when you take a bank loan, LIBOR is your London interbank offer rate. That is your London. Each bank also may borrow from each other, right? That we call it as LIBOR. Okay. In India, we have MIBOR, Mumbai Interbank Offer Rate. The rate at which each banks offer loan to each other, we call it as LIBOR or MIBOR. That is generally used for your loan fixing rate. Because when you take a loan from bank, you can take a fixed rate or a fluctuating rate. If you are taking fluctuation options, they will say loan will carry an interest of LIBOR plus 2% or LIBOR plus 5%, like that. In that range, they will use the LIBORs. Okay. All right. Yes, LIBOR, they are planning to replace it. We'll see. Not sure whether it has already come into place or not. I need to review that. Okay. Come back. Coming back to question number 2 now. You are required to ascertain, underline the word you are required to ascertain gain or loss recognized for financial year ended 31st March 20x1 and 31st March 20x2 as per accounting standard 11. Goods purchased on 1st January for US dollars 15,000. Same example that we took. Correct? No? And on that particular date, exchange rate was 75, meaning $1 is equal to 75 rupees. This is what do we call this as? This we call it as TDSR, as in transaction date ka spot rate. Perfect. Exchange rate on 31st March. So 31st March is the date on which you close your books. The exchange rate on 31st March, what do we call it as? CR, as in closing rate. Date of actual payment was 7th July. That means this is a settlement. The exchange rate on the settlement date, we call it as SDSR, as in settlement date ka spot rate. That's all. Same example we also took and solved. One more for practice. Fatafat can we do? Okay. Question number 2. Initial recognition. Sir, when will you initially recognize? When did you purchase? 1st January 20 X1. Can we start? Sir, initially all foreign currency transaction, be it monetary or non-monetary, at what rate? Transaction date ka spot rate. What sort of transaction did you do over here? You purchased the goods, and is it in Indian rupees or dollar value? Dollar value. And are you settling immediately or much later? So obviously it's a case of a credit purchase. What's the journal entry for credit purchase? Purchases account debit. How much purchase value, sir? $15,000. Sir, on 1st January 20X1, which is your transaction date, what was the dollar rate? $1 is equal to 75. If you're confused with conversion again, it's like this. $1 is equal to 75 rupees. How much dollar value did you purchase it? $15,000. If $1 is equal to 15 rupees, means $15,000 will be equal to how much? So when you cross multiply, what it will be? 15,000 into 75 divided by 1, which will be this. Okay, that's how directly we write. So directly can I write here? 15,000 into 75, which is 11 lakh 25,000. So purchase account debit to creditors account, which is 11 lakh 25,000. This is your initial recognition. I'll call this as maybe A. Next, B. B is a settlement or B is the closure. You are doing the settlement on 7th July, but before 7th July, you are closing your books on 31st March. That means, can I say this is on your financial statement date? Financial statement date. That is on 31st March 20 X1. What do you have to do, sir? First, purchases means these are goods. Purchase means these are goods. If you purchase and if you don't sell, you will treat them as closing stock. Closing stock is an example of non-monetary or non-monetary item. Non-monetary item. Have they told closing stock is valued at NRV blah blah? So should we have to worry about non-monetary item? First of all, did I say CA interest syllabus concentrate on non-monetary item? So you don't have to even worry about the stock, PPs, etc., unless they specifically ask for it. So the concentration is primarily on what component? Monetary item, which is your creditors. And creditors balance, have you already settled or it still has a balance on the date of closure? On the date of closure, meaning on the date of balance sheet, this creditor still has a balance. And what does the standard say, sir? All monetary items should be converted using closing rate. And closing rate on 31st March, $1 is equal to how much? 74. Okay, 1 minute, hang on. Now tell me, without looking further, happy scenario or sad scenario? This one. We're looking at these two. Can you tell me it's a happy or a sad scenario? Happy or sad? Happy. Sir, on the day you did the transaction, sir, you purchased the goods means you need to pay. And you have to pay it in rupee or dollars. That means first you need to purchase and then give it. Because you don't have dollars, what you have is Indian rupees. You have to purchase dollar and give it off to your creditor. When on the day you did transaction to purchase $1, how much rupee you had to give away? You have to give 75 rupees to purchase $1. This is on which date? Transaction date. But on the closing rate, on 31st March, to purchase $1, should you have to pay 75 or just 74? To purchase $1, you need to give away only 74. That means you have to give more rupees or less rupees. You can buy same dollar by giving away less Indian rupees. So obviously for an Indian entity, this is a happy scenario or a profitable scenario. Yes, sir. Problem? Huh? No problem. Okay. So this is a happy scenario. Or another way around, monetary item should be shown in your balance sheet at the closing rate, meaning creditor should be converted at 75 or 74. 74. That means 15,000. What should be the creditor's balance? Actually, creditor's balance in the balance sheet should be 15,000 into 74, which is how much? 11 lakh? 11 lakh 10,000. That is the balance you need to show as creditor in balance sheet. But currently, creditor's balance is shown at 11 lakh 25. It has to be shown at 11 lakh 10, but currently you are showing it at 11 lakh 25 means creditor ka balance you need to reduce, increase what? You need to reduce. Creditor has credit balance because being a liability. What journal entry you need to pass or something which has a credit balance to reduce we have to debit. So what will be the journal entry? Creditor's account debit. How much? 1125 to 1110. That will be how much? 15,000 or you can calculate also. Creditor, no sir, you need to convert it at, you have to convert this at 74, but you have converted at 75. How much extra did you use? 1. So $1 you have converted at 1 rupee more for $15,000. How much? So this will be how much? 15,000 rupees. Creditor's account debit to what? It's a gain. Have you received this gain or this is a bookish gain? This is a bookish gain arising due to foreign currency fluctuation. Where should we transfer this off? To P&L account, which is 15,000. This is what you will do on the balance sheet date. Okay, great. Next, point number C. Last is your settlement. Okay, what is your settlement date, sir? Here, settlement date on 7th July 20 or 20x1. Okay, what FS is financial statements. FS is financial statements. On 31st March, you have to prepare financial statements like balance sheet, P&L, and all that. Okay, on 7th July, what was the exchange rate, sir? $1 is equal to 73. Okay. Sir, this is a settlement and all foreign currency transaction, be it monetary or non-monetary, all settlement transactions are recorded at settlement date ka spot rate. Whom have you settled here? Creditors. What's the journal entry for creditors settled? Creditors account debited to bank account. Okay. Sir, how much did you pay to the how much did you pay to creditor? $15,000. And to purchase $1, how much Indian rupees you need to pay off? 73. To buy $1, you need to give away 73 rupees. So to purchase $15,000, how much money we have? How much Indian rupees will leave from your bank account? 15,000 into 73, which is 10,95,000 is your payment. That is, or this much Indian rupees will be get deducted from your bank account. But is creditors ka balance 1095? Because you have settled creditor, no? So creditor account should be closed. Check, sir. Creditor's balance is how much? Initially you credited by 11,25,000. Then you debited by 15,000. So if you do the math, creditor balance will be 11,10,000. So creditor has a balance of 11,10,000. Meaning till 31st March, you thought you have to pay the creditor 11,10,000. But eventual payment came up to be only 10,95,000. Sad or again happy? Bumper scenario. Yes, no. So how much is that balance? Again, you're getting 15,000 balancing figure. So loss or gain? You're crediting, so obviously it's a case of a gain. It's again a forex gain or loss. Instead of directly writing P&L, you can also credit foreign exchange difference account and then foreign exchange difference account debit to P&L. Like that also you can pass it as a separate entry or directly credit P&L, it should be fine. So this P&L is nothing but your forex what's forex gain arrived as a balancing figure. In the previous case also it's a forex gain itself. That's all. Problem over. Correct. Sorry. What? You will include all that as when you and that and all will come in case of forward rates generally. Okay, when you will freeze the rate, you can. You mean to say when to buy the dollars you are paying directly to pay it. Can I move on to the next question, sir? Okay, 2 over. Let's go for question. Online also everybody has copied. Can we go for others who are done? Can go through question number 3. Question number 3, you can start going through. Sir, you can express all this by passing journal entry, or you can also write it in words. That is also all right. Meaning you can write on the closure date, foreign currency monetary item will be shown at closing rate, and any forex gain or loss will go up to PN. Like here in this case, we have a forex gain of 15,000, which will be transferred off to PN. Like that, you can write it in words, but I thought you can connect better with journal entry, so I'm expressing it in journal. The way you want to present. I think study material, some problems they give it in journal, some they give it in words. Study material ka solution. You can follow whatever approach, that's all right. Now, forex gain, very different. May not be extraordinary income, because if you're dealing with foreign currency items, that means that is part and parcel of your business. So it will not be extraordinary. It may be exceptional item. If it's once in a blue moon, etc., it may be considered as exceptional, but it may not be extraordinary in my view. No, even some cases, no, if you are dealing with, like, we have a few things, few of our students, like a few of my ACCA courses are purchased by people who are there in Thailand and Israel and people like that. Yes, we have seen. So they have given it as in foreign dollars. ACCA course, generally we have few, not many, but we do have some foreign audience. So that is part and parcel of our business. So it is not extraordinary. Okay, it may be considered as an exceptional, but definitely not extraordinary. Okay, coming back to this question number 3. Kaleem Limited borrowed US dollars 4,50,000 on 1st January 20x1. So what do we call this as, sir? This is your transaction date, which will be repaid on 31st July. So you have taken a loan, and loan is in Indian rupees or in dollar? No. So we have taken a foreign currency loan. Stop there. Foreign currency loan given or taken. Doesn't matter whether it is a loan given or loan taken. Both are what components? It's a monetary item. Because if you have given a loan of 450, how much principal will you recover? 450. If you have taken a loan of 450 worth principal amount of loan, how much principal will you repay? 450. We're not talking about interest, we're talking about principal. Yes, so principal value is fixed. So loan given, loan taken, both are an example of monetary item. In this case, we have borrowed. So it's a foreign currency loan taken on 1st January, repaid on 31st July. Kaleem Limited prepares financial statements for the year ending 31st March. Exchange rate they have given. 1st January ka exchange rate is $1 is equal to 48 rupees. What do we call this as, sir? TDSR. Transaction date ka spot. On 31st March, $1 is equal to 49. This we call it as closing rate. On 31st July. 31st July is when you need to repay the loan. That means this is what? This is your settlement date ka spot rate. $1 is equal to 49.5. Perfect. That's all. You need to journalize this. Can we do it? Question number 3. Okay. First is your point number A, initial recognition. When is your initial recognition happening, sir? On 1st January 20x1. Not homework, ma. We'll do this. Okay. First, what's the journal entry for foreign currency loan taken, sir? What's the journal entry for loan taken? When you take a loan, money will come into your bank account, but you need to repay that loan. So that means correspondingly, you need to create a liability also. So the journal entry is bank account debit to bank loan account. So first journal entry, bank account debit. How much dollar loan did you borrow, sir? 4,50,000. And on 1st January, what was the exchange rate? Because this is a transaction, so transaction date ka spot rate we need to use. So $1 is equal to 48 rupees. If $1 is equal to 48 rupees, then $4,50,000 is equal to how much? 2 crore 16 lakhs. So that means this is an amount, or if you want it, this is an amount in Indian rupees. Okay. So bank account debit to what? Can I write it as foreign currency loan? Bank account debit to foreign currency loan, which is 2 crore. Narration is pretty straightforward. You'll write being foreign currency loan borrowed. Being foreign currency loan taken accounted. Being foreign currency loan taken accounted. You can write it in your own words. Write whatever narration, but do write one. Whatever means, don't write your other stories, you know. Okay. So now you took a loan on 1st January, but when are you repaying? 31st July. So in between this transaction and settlement, do we have any closure? Yes. That means you are preparing, you have to do something on financial statements. Financial statement on which date, sir? 31st March 20x1. On that day, what do you need to do? You need not give this heading. Heading is for your reference only. Instead of journal entry number 1, you can write this date here only. Here only you can write 1st January 20x1. You can cut off the date also. That's only for your extra clarity is all. Okay. So now, sir, this foreign currency loan, what sort of an item? Foreign currency loan. If you have taken $450,000 worth of loan, you have to repay $4.5 lakh only. That means it is a case of a monetary item. So, NMI a monetary item. Any problem there? Loan is a monetary item. Loan taken, loan given, both. Typo or any confusion there? Someone who said non-NMI there. Not an NMI, it's an MI. Okay, no. Okay. So monetary item should be reflected in your balance sheet or financial statement at closing date. So that means what should be your foreign currency loan balance? Foreign currency loan balance should be what? You have taken $450,000 worth of loan, and this loan has to be shown, being a monetary item, should be shown in your balance sheet at closing rate. What is the closing rate, sir? $1 is equal to 49. So 4,50,000 is equal to how much? 2 crore? 2 crore 20 lakh? So the loan should come in your balance sheet at 2.2 crore, but currently shown at 2.16 crore. So loan balance you need to further reduce or increase? Increase. Loan is a liability. It has credit balance. How do you increase it, sir? Credit it again. What will you debit? First of all, this loan balance is increasing only due to forex fluctuation. Yes, that means what will you write? So you can write here P&L account debit. Okay. So $450,000. You can also show like this. Currently, you have converted this loan at 48, but it should be shown at closing rate. What is the closing rate? 49. It should have got converted at 49, but you have currently converted at 48. That means you need to increase it by $1. So how much will be this? 4,50,000. Or you can compare these two. 2.16 crore minus 2 crore 20 lakh 50,000. That difference, if you find out, again you will get 4,50,000 itself. Like that also, if you want, you can calculate. Done now. So P&L account debit to what? To foreign currency loan. How much, sir? 4,50,000. Sir, there is another item treatment for this. I'm ignoring that since I've not explained that concept. Directly I'm using P&L. There is another treatment also. I will discuss that. Okay. So for now, write whatever I'm writing. That's good enough. So again, the narration will be being forex gain or forex loss. Being forex loss accounted. Principal will not change. If you take $4.5 lakh worth of loan, you'll repay that much. We're not talking about interest component. We're talking about, because interest will not come in balance sheet. What comes in balance sheet? The principal component. So principal is fixed over here. Principal will never change in case of any loan. Why will principal change? Huh? That's interest component. No? Yeah. Again, that's interest on interest and all is interest component. As we are paying, principal also change. See, when we are saying principal changes, what we mean to say, instead of 4.5 lakh principal, will you pay 5 lakh? Instead of 4.5 lakh loan, will you pay 5 lakh? No. If you have taken 4.5 lakh, you have to pay 4.5 lakh. Yeah, periodically when you go on paying, its balance will reduce. That is due to payment. Okay. But how much you need to pay? That value is freezed. At what value? $4.5 lakh. Hence, it's a monetary item. Like that. Okay, now. Alright, the next one, settlement, sir. When are we settling this? 31st July. Okay, so we are doing a settlement. So we'll write this as settlement date. On which date? 1st 31st July 20x1. So we know the provision already. All settlement are recorded at settlement date ka spot rate. So when you took the loan, the journal entry was bank account debit to foreign currency loan. When you repay, ulta, the loan as a liability should be closed. Liability as credit balance to close, we have to debit. So the journal entry will be foreign currency loan account debit. Foreign currency loan account debit to. Huh? What happened? Flickering. Huh? Online, is there any problem in the video for you? TV is flickering. Huh? No, matlab, are you also facing anything? Is what I'm just saying. 1 minute. Maybe we'll finish off this and then maybe we'll switch it off and switch it on. Try sometime. For now, can we manage this? Anyway, I'm dictating. You can kind of listen to that and write. It's fine. So foreign currency loan account debit to what account? To bank account. Sir, foreign currency loan balance is how much? Initially you credited by 2.16 crore. Again you credited by 4,50,000. That means foreign currency loan balance is 2 crore 20 lakh 50,000. So is this liability required or close? So it has a credit balance of 2 crore 20 lakh 50,000. We will close by debiting to that extent. But are we paying 2.2 crore 50,000 or something different? Sir, we are paying $4,50,000. This is a settlement. All settlements are recorded at settlement date ka spot rate. Settlement is 31st July. On 31st July, $1 is equal to 49.5. $1.49.5. So $4.5 lakh, how much? 2 crore 22 lakh 75,000. That means sad or happy water? Sad. We thought we will pay 2.2 crore, but we ended up paying 2.22 crores. So something extra. So it's a case of a forex gain or loss. Loss. Transfer of where? To P&L account. How much is that? We'll arrive at as balancing figure. 2,25,000. That is your forex loss. Or you can write here being settlement and forex loss accounted. That's all. So this problem is done, not done. It's okay. Can we do a few more? Or you're already reaching the zone? Zone, continue, break, what? It will take full concept. I need another 1 hour. Okay. Yeah, few more concepts will take around 1 hour. Or if you want, I'll just see maybe. Yeah, I think they deal with currencies. They will not have any inventories. You will show it as financial asset. It will not be inventory. Yes, but there is a specific overriding provision that it is considered as financial asset. Cash is always a financial asset. Not there in your syllabus. Don't worry. Again, stick to some things, few things. Not a juncture to discuss. So you asked it, I'll ask it. If you ask why, I'll have to give you half an hour justification for it, which you are not ready. I am also kind of not this point. There is a specific provision. Cash is always a financial asset, specifically included in financial asset definition. Don't worry about those. Stick to the things. Okay. Yes. Are we done with this now? Now what are we doing? Are we continuing? Are we taking a break? What is the popular one? Break.